Candlesticks are recognizable chart patterns that investors use to make trading decisions. The name comes from their rectangular shape and lines that resemble a candle with a wick. Bullish candlesticks show entry points for long trades and can predict when a downtrend is about to reverse. Candlesticks represent one day of price data for the stock, specifically the opening, the closing, the high, and the low. The color of the central rectangle tells investors whether the opening or closing price was higher. A black or filled candlestick means the closing price for the period was less than the opening price, and a white or hollow candlestick means that the close was greater than the open. The lines at both ends are called shadows and show the price action for the day. The upper shadow shows the stock's highest price, and the lower shadow shows the lowest price. Groups of daily candlesticks fall into recognizable patterns with descriptive names like the hammer, three white soldiers, dark cloud cover, and morning star. These patterns form over 1 to 4 weeks and can give valuable insight into a stock's future. Candlesticks provide an extra layer of technical analysis on top of fundamentals for day traders to identify patterns and make trading decisions. But investors should use candlestick charts like any other technical analysis tool to study the psychology of market participants.
Two moving averages represented by these two lines here. They have different time periods, so they're not exactly the same, and the difference between them is represented by the individual red lines. What does the MACD help you identify? It helps identify points in the price chart where the trend might be accelerating, when these two lines cross. So there's two indications of that on this chart, here and here. A lot of traders use this for an entry signal.
A cup and handle pattern on a bar chart shows a trend in upward performance that trades down and pauses before resuming its upward direction. It starts when a stock's value peaks. The stock incurs selling pressure and descends about a third of its initial high point. The stock then trades near flat levels for a time, forming the U-shaped bottom of a cup. A V-shaped bottom indicates the stock reached a low point, then quickly recovered. The stock eventually ascends smoothly to a point that nearly matches its previous high, then continues to form the handle. Handles usually last less than a month. They can be in a straight line or descend up to a third of the gain of the cup's right side. A move up usually means the stock's upward trend will resume. Trading volume dries up on the decline, remains low in the base of the cup, and increases as the stock ascends. Strong volume is a clear sign that the upward trend will continue. A cup and handle pattern may take anywhere from 7 to 65 weeks to develop, but the form is always the same. The pattern has historically preceded large gains in many stocks.